Hello, welcome to another episode of Executive Suite. I'm Thomas Braun. I'm your host. Today we have Denzel Cadet from Cadet Legal AI. Denzel, can you please give us a quick introduction to your firm, and then we'll start talking about mergers and acquisitions, which is what this episode's going to be about.
Sure. Thanks, Thomas, for having me. My firm, Cadet Legal, is a lean boutique corporate transactional firm. We don't do any litigation, at least not yet. We're focused on corporate transactions, and it really builds on my past 10 years of experience in corporate transactions, starting at a big Wall Street firm where I worked with asset managers in the private equity space before I rotated to Bay Area based firm where I did much more VC and tech related deals before finally launching out on my own. And Cadet Legal represents kind of the culmination of those things where I'm doing the same type of work that I've done all along, meaning advising people in raising capital and then deploying that capital. The deploying capital part, I think, is what we want to talk about today. So I help people in private equity as well as VC buy and sell companies or parts of companies. And it's not just me, it's also a team of a few other associates and a paralegal. Really happy to be here with you today, Tom.
Great. Now you're located in New York City, correct?
Yes.
Okay. And did I get your website right? It's cadetlegal.ai.
Yes, it is.
Okay. And now, why did you decide to go with the .ai?
Right. So it's definitely in part a marketing move, but it also is not just a superficial move. It also reflects our approach as a firm. So I mentioned that we are a boutique, a relatively small team, but we are able to do, projects and deals, representations that surprise people. And part of that is because we do have that kind of big firm Wall Street work ethic. There are some late nights, but part of it is that we leverage technology. We all know that AI is not just the next thing, it's here to stay. And it's not a new technology, but recent advances have it a part of our everyday life. And we as a firm, we see AI as an opportunity. It's an opportunity, one, because a lot of our clients are active in AI, everything from our startup clients who are coming up with new med tech or software SaaS products based on AI to, our private equity investor clients who are buying companies and bringing AI tools in order to improve operations and the valuation. It's important to our clients, so AI is important to us. But deeper than that, we use AI for our own work as well. We use it as a tool of efficiency, a way to leverage technology so that a small team can go against sometimes bigger firms on the other side of the table. So cadetlegal.ai, one, to just let people know that we are very much invested in and involved in this trend, but it's also just reflects the work that our clients are doing.
Yeah. Okay. Well, that's a good answer. Basically, with AI, it seems like it's kind of leveling the playing field where you now have all this power. It's like having a law library and a law librarian and a research staff at your fingertips without having to actually have them. Just
Mhm.
harnessing that technology. But let's jump into M&A right now because that's kind of the focus of this series here. And I wanted to ask you about any new trends that you see in the M&A landscape for the second half of 2025 that we're in.
Sure. So I think I'd like to talk about two kind of high level trends. One in more of the tech space, and one in more of the private equity space. And then we can kind of go deeper into either one, whatever you're interested in. We mentioned AI and tech companies, and as part of our practice, we do work with startups and tech entrepreneurs. And one of the big trends that we're seeing that we've been talking about really since early 2024 is that tech companies and startups are finding that their financing and their exit options have changed. In the past, there were a lot of very lucrative financing rounds, and startups are having trouble finding those financing rounds. In fact, they're seeing down rounds, they're not able to raise at all. Similarly, the ideal exit for many startups was the IPO, but we're seeing again there's been some rebound in 2025, but over the last 18 to 24 months, startups are having a harder time raising money and exiting. The exception that we've seen in the market and in our own practice is a lot of tech companies, AI included, are finding that they're able to raise capital or to exit via M&A. So we've been doing a lot of startup and when I say startup M&A, it's not all a private equity company, one of my private equity clients coming in and buying a tech company. A lot of it now is one tech company buying another tech company. I just had a conversation with a client today. She has a social media membership based platform, and she's already at this early stage. We were just talking about raising a series seed, but now she's considering, I might be able to grow by acquiring this other small tech similarly related company. So I think the first trend I want to talk about is that is not just for private equity or for big companies, it's also for startups. That's a huge trend we're seeing.
Interesting. So, and I'm guessing they would be acquiring this other company in exchange for shares as opposed to cash.
Right. And so that's part of what's interesting in this new world where liquidity, it's really about liquidity. People are having issues getting cash. I've seen a mixture of considerations. So I have seen deals where it's, a regular acquisition where one startup is acquiring another startup for a sum of cash, whether that's a stock purchase or asset purchase. But I've also seen really interesting, stock for stock deals. I saw last year a deal where the consideration was a simple agreement for future equity, meaning that the quote unquote acquirer here was paying with a safe. Now, if you are familiar with safes, a safe is a piece of paper. It's an IOU that says, I'm giving you this piece of paper. And this piece of paper means that at a later date, when I have an equity financing round, you get to convert this piece of paper into equity in my business. So to take a step back, I know I just said a lot there, but just what the actual transaction was a buyer giving a safe, an IOU to another tech company and buying their company that way. So what was the target? Was the seller actually getting? They were getting a right to future equity in the buyer and future equity in a round that hadn't happened yet. And so that's just one example where we're seeing both VC investors as well as founders getting creative in how they're finding liquidity or how they're growing their business.
So that's actually really interesting to me. I see safes are being used in crowdfunding, for example, where people can invest in something and then the price of the shares will be determined at some point in the future, maybe, or there or not, or it could be set at the time of the transaction based on that valuation. So I'm just wondering though, with these private transactions, how does that really work? Like, let's say that person then with that safe just does a private placement with one investor. Would that then trigger the safe, or does it have to be like a big round?
Right. So, as with safes where, it's a startup raising from a bunch of investors in a more crowdfunding type of situation,
Hmm.
there's similar structures apply. So the safe had terms by which it was triggered, right? What triggers conversion. And so usually there's something called the qualified financing or, a conversion event, and it sets a threshold for how much. So in this case, again, the buyer is giving this. So that save will convert into equity in the buyer when the buyer goes out and raises kind of in a
A
context
minimum,
like you're familiar,
right?
raises from outside investors, but it needs to raise a certain amount.
Mm,
And usually with safes, it's also a certain type of equity round, right? Although not always the case, it may specify that it can't just be a sale of common stock, or it usually carves out shares to advisors. It needs to be a true preferred equity financing round. So, a series seed or series A, something like that of a certain dollar threshold in order to trigger conversion. That's usually how they work. And in that particular deal, that's how it worked.
yeah. Let me ask you a question about M&A advisors. Are you seeing that these different parties are coming together through M&A advisors, or are they just finding each other by themselves?
I'm seeing a mixture. So I think in the we were just talking about startup M&A, which again is part of my practice, but I also do other, lower middle market M&A, non-tech companies. But in the startup context, I'm not seeing them as these deals come together as much through M&A advisors. I'm seeing those type of deals come into play through kind of industry relationships, right? So, the company, the deal that I just talked about was two
Hmm.
SaaS companies that were in a similar space. One of the founders met, I think, an investor in the other founder, and they talked and they realized that there were synergies in that, you know, one was having a bit more trouble fundraising than the other. So the target here, if you think about it, is not able to raise capital. That's why they're accepting an investor. And the buyer clearly felt confident in their fundraising ability because they're saying, hey, take this piece of paper. Don't worry, we'll be able to raise money later. But in those type of deals in the startup context, I'm seeing more of it being relationship based. Whereas for other M&A deals, so think of your HVAC companies, your plumbing companies, we just did a staffing agency deal. Those, it's more of a mixture. And I would say, the deals that I'm seeing, a lot of them are through M&A advisors or brokers, maybe 75%, let's say. But I would say that the deals that are getting closed, right? So not just deals that I'm seeing across my desk or we're taking a swing and sometimes it's a swing and it's a hit, sometimes it's a swing and a miss. Most of those are from brokers, but the deals that are actually getting done tend to be non-broker or website deals. They tend to be proprietary deals based on relationships. And so I think there are reasons for that. But generally speaking, I think for the smaller startup deals, not as much M&A advisor activity, although that's changing. For the non-tech deals, I am seeing a lot more of, the brokers, the M&A advisors, especially because of this whole entrepreneurship through acquisition, ETA trend, the silver tsunami, as some people talk about. More and more people also are, as they're looking to exit their business, are realizing, hey, there's an opportunity for me to make some money and pad my retirement. And so they're going to brokers. So I think in that context, we are seeing more of the M&A advisors and brokers.
Interesting. So I saw a posting, it was on LinkedIn by a portfolio manager, and it was kind of a strange comment, but he was talking about how, the days of big multiples are over, and his starting point is now like 2 times earnings or whatever. And
Hmm.
I thought you're an idiot, really. Like, who's going to sell their business for 2 times earnings?
Hmm.
But, like, what do you see in the market as like, are prices going up? Are they going down in terms of multiples?
Yeah, so I think that, it's really about the market, right? So, first of all, multiples, and this has always been the case, and it's not just a feature of the moment, that multiples depend on industry, right? So, I was just talking about a SaaS company. SaaS companies usually tech companies tend to get higher valuation multiples, whether it's investment or a full sale than some other businesses, right? So it does vary by industry. With that said, yeah, a two times multiple, it's on the lower end. I've seen deals where that's the case, but I would say that within industries, if we look at a whole, that I think multiples are getting tighter, and that's just because of the demand. So we've seen, again, looking at the tech and startup world, how because of, there were years and years of huge financing rounds and valuations and exits, and now it may have been a bit of a bubble that is now popped, where now founders are having a harder time. They're having to justify investment. They're having to show revenue before they're getting investment. I think that in the context of non-tech companies or in, this lower middle market ETA trend, we're starting to get maybe a bit of not a bubble, but the market is getting crowded. A lot of people now are looking, before everyone wanted to start a tech company. Now I think a lot of people want to go buy an HVAC company, want to go buy a plumbing company, want to buy some, lower. We're hearing about these wonderful, you know, not as exciting tech companies that generate revenue, and that there's an opportunity to become an entrepreneur through acquiring these type of businesses. And I do think with that now, that the market is getting very saturated with, one, a lot of buyers who are thinking, and I'm seeing a range. I went to Princeton for undergrad. I'm seeing, you know Ivy League classmates who are now going and trying to buy plumbing businesses after years of finance, right? But I'm also seeing, fathers and sons with more of a blue collar background that are looking to expand and build their business that way. We're seeing a range of buyers, but with so many buyers, of course, there's more competition for deals. So in that sense, some of the multiples have gone up because there's more competition. But what I've been seeing is a lot more of sellers. There's a lot of inventory now on the market, as far as there are a lot of deals. And so that a lot of people are being encouraged, hey, exit your business and you can cash out, like we talked about, provide for your retirement. And because there are a lot of deals out there, I do think that there's it's not as much of a seller's market with these deals as it might seem. So I do think that multiples I've seen in the last year, multiples generally have ranged from three times EBITDA to the highest I've seen is a little bit past five for deals that get closed. Now I've seen deals where the offer was seven times EBITDA, or you know I saw one that was nine times, but it didn't get closed because one of the things with these businesses, they're great businesses, mom and pop businesses with recurring revenues, but sometimes the financials, either through a lack of sophistication with the accounting and the bookkeeping, or in some cases, people they're trying to cash out and they may fudge numbers a bit, unfortunately. With the financials, the price that's listed by the broker or the M&A advisor, once you come in and bring your own accountant to do a quality of earnings, I'm seeing in most cases that whatever the price was, it's going down. So, short answer is I think that multiples were going up for a bit, but I now think that there's much more fight, and it really depends on industry. But there are a lot of people trying to sell businesses right now, and so I think that has it's not just a straightforward multiples are going up or down.
Okay. Um, and you mentioned business brokers, if I heard correctly. So a lot of
Yeah.
these brick and mortar companies, the smaller ones, I guess, they are represented by business brokers who are kind of like
hmm
real estate agents, right? And so
Yep.
if somebody wants to buy one of these businesses, there are listings somewhere, I guess. Do you know?
Yeah, there are various websites like Biz Buy Sell, some other websites where people are and more. So there's even now a business of people creating their own website to list businesses, right? And saying, "Oh, our website is different than these others." But yeah, generally speaking, much like you would for real estate, whether you're renting or buying, now there are these websites you go on and you pick your state or region, you pick the type of business. S mergers is another one. You're able to, submit information to get what's called a teaser or a SIM, confidential information or investment memorandum. It gives you more info about the business. And if you're still interested, then you can submit an LOI, or depending on a letter of intent, or depending on the site, they may have their own application. With that said, you raise a really good point, and I think that's one of the things I'm seeing in this lower middle market M&A is that yes, as people are flooding to buy these businesses and people are flooding to sell their businesses, a lot of people, have a good business experience, but don't necessarily have experience with M&A, which is why podcasts like this are so important, because you can run a successful business for 40 years and never engage in M&A and not really understand the process and what it entails. And so what I'm seeing is for a lot of first time sellers and buyers, the closest experience they have is a real estate transaction. And so you're seeing even with these websites, they're set up like real estate websites. And that's a helpful analogy, but it does cause some difficulties for true M&A attorneys like me, where, people's expectations for real estate they're similar and they're helpful intro, but M&A is very different than real estate.
Yeah. So here I'm in Vancouver, and one of the resources that the bar association here has is they have practice checklists.
hmm
And the practice checklist for acquiring a business, it's like 20 pages long.
hmm
And, there's like almost no end to how many searches you could do. So you really have to figure out how much you want to spend, how far you do
hmm
you want to search, how many jurisdictions do you want to do this in, and depending on the size of the deal, how much due diligence do you want to do?
hmm
How do you approach that? Do you sit down with your client and say, okay, well, which searches do you want to do? Because we could do 100 if you want, or we could just do 20. So what's your process there for deciding what kind of due diligence that you need to do if you're representing a buyer?
Right. No, that's a great question. The first thing is, I think there are two questions in there. The first is kind of finding a deal, right? How do we help them with finding a deal? And then there's also there's diligence there, but then there's the diligence of we've selected this target company.
Hmm.
How much diligence do we need to do on, for this target company? So for the first question, generally speaking, as a lawyer, it's not our job to find the deal. With that said, one of the things that I've enjoyed about having my own practice and not being in big law is I have a bit more flexibility. I'm the managing member here. So, for certain clients who I know and have a relationship with, I will actually help them in their deal search. But in either case, it flows from the client. They tell me this is the industry, this is the size I'm looking at. And then because of my conversations with other clients, with other colleagues, I keep my ear open for deals that make sense for that client. But generally speaking, when you're starting off on a search, you're going to want to know what industry or industries you're interested in, what size of a company you're looking for. Many of my clients look at EBITDA, right? So for a lot, the sweet spot is, 1 million to 5 million EBITDA for a good lower middle market transaction. Part of that also has to do with, the availability of financing kind of starts at that 1 million EBITDA size, although you can, get do other options. But it really flows from the client and what industry, what size, what geographic region. And then from there, we help them submit their letter of intent, and then the real work begins, the diligence. For me, diligence is one of the most important parts of the process. And when I say diligence, it's not just the legal due diligence, legal and operational due diligence that we do for our clients, but a very important part. And I always have this conversation with clients: who is your accountant or CPA? Who is going to do your quality of earnings or your QOE? Because that is one thing that is very different doing these lower middle market deals today versus when I was in big law in New York 10 years ago. The difference is with these deals, we mentioned the financials. Sometimes they're not as sophisticated or well kept, or because there aren't checks and balances, sometimes they're straight up fraud.
They're
So
unaudited, I guess.
unaudited, which is there's a nice version, but we've seen where people really try to cook their books. And so
Mm,
I don't move forward with a client unless if they aren't qualified themselves to do a quality of earnings of the
mhm.
financials without them signing the accountant. So, I tell them, more important than me for the early stage. And, when does a lawyer say you don't need me? But more important than me is your accountant, because a lot of these deals fall through before we even get to the real legal diligence, because you start kicking the tires on the financials and they're not exactly what you hoped or expected. So that financial diligence is a huge part of it, but we work hand in hand with the accountants on that. When they're doing the financial diligence, we do the legal due diligence. How much is required? We try to do as much diligence as possible where we can make recommendations to our clients, right? So the first level of diligence is we make we do enough digging to get to a point where we can say we don't see any deal stopping red flags. That's kind of our first initial diligence memo to our client. We've dug through the legal and organizational documents, the contracts, the employment agreements, any past lawsuits or investigations they've had, all of that. We're pretty thorough, and that's not the case for all law firms at this end of the market. But that comes from my background and the fact that a lot of the risk is on the buyer, right? They're buying something and not understanding. And to my earlier point about how a lot of people have real estate as their only experience, real estate, you have this concept of caveat emptor, buyer beware, right? So, you can do your own inspection, but sellers generally, don't have as much of a duty to disclose things. It's on you to figure it out. People sometimes bring this mindset to M&A, and it's not true. M&A is not caveat emptor, right? Buyer beware, especially when you're talking about sale of securities. There are rules, in B5 and other rules about misrepresentation and fraud when you're selling a company as opposed to real estate. So the our legal due diligence process is a bit more involved than some people may be used to at this end of the market. But you have to realize that on the buy side, especially, there's a lot of risk. So we make a first initial recommendation of, hey, we've seen, these are kind of the high level risks that we've seen. In either we've seen, these are risks that are so great that we don't recommend you go forward at all, or yeah, there are risks, but we feel that we can structure a contract around them. If you're comfortable with these risks, then, we'll continue doing a deeper dive on diligence. But now our focus is on, you know, what specific reps and warranties do we need to put in the agreements, or, what specific operational things do you need to know so that you can successfully operate the business afterwards? So the diligence kind of shifts, but the first instance is, let's just see if it makes sense to even have a deal here.
Okay. Now with financing, I'm just wondering, you were talking about financing starting at uh, at least 1 million EBITDA. What kind of financing can people look for?
Right. And again, it's not a hard and fast rule. It's a general range where it's kind of easier. But when you're talking about financing, oftentimes for these deals, people use SBA loans. And so that is something that also, when we're talking about market trends changing in the last, in 2025, the rules for SBA financing have gotten a bit tighter. They've gotten a little less borrower friendly, and there are various reasons for that. But I do think it's in part a response to a bit of a oversaturation in the market. Again, there's not quite, I wouldn't say quite a bubble, but people are rushing to do these small business acquisitions. And so things like waivers of fees and kind of more leniency as far as vetting criteria for SBA loans from the government, those things have shifted. And so it's gotten a bit harder to get SBA loans. With that said, besides SBA loans, there are traditional bank loans, as well as various, unitranche and other lenders who kind of make their business filling in the gaps where you can't get a SBA or traditional bank loan. And so it really depends, like anything else, on okay, you as a borrower, what is your risk profile, as or your credit, as well as the particular deal. Your lender is going to want to look, just like your lawyer is doing legal diligence and your accountant is doing your quality of earnings, financial diligence. The lender would be another set of eyes because they need to see if it's a risk worth underwriting for them.
Do you have any closing remarks you'd like to make before we wrap this up?
Sure. I think if I had to give kind of a high level market trend and a recommendation based on that market trend, I would say whether you are more in the tech VC startup space or whether you are in the more brick and mortar or mom and pop business space, what the market is telling us is that you have to create actual value. If you're a startup, it's not enough to have a flashy name and a nice deck. You have to develop your operations, your services, your product. For a small business owner looking to exit, you want to make sure that your operations are as clean as possible. Your books and financials are clean because that's going to help drive your valuation and your opportunity to exit. And similarly, on the buy side, when you're looking at these businesses that look great and have great numbers, you really want to look at the operations of the business because you are going in and buying the business, and your opportunity to increase the value is going to be based on how well you run that business. So as you do your diligence, don't just look at the financials, but also look at what does it take to make this place tick, because at this point in the market, it's really about creating value. And I would say it's through creating value through operations.
Thank you very much for coming on and sharing all that with us. It was very interesting to talk to you, and I'd like to hear more.
And Thomas, thank you so much for having me on. I really enjoyed our conversation, both recorded and a few minutes before. I hope that all your listeners keep tuning in to this great M&A program that you're providing. And please don't hesitate to reach out at cadetlegal.ai if anything we talked about is of interest to you.
Fantastic. Okay. Well, till next time. Bye for now.